All right, switching gears, considering everything going on in the world, markets are back to their calm, some would say. Pros say that reflects hopes for a speedy end to the Russia-Ukraine war, which could begin to drive oil prices down and ease supply chain pressures. But is all that too optimistic? Joining us now is Candice, Managing Director and Global Head of Strategic Advisory Solutions at Goldman Sachs Asset Management. Candice, always good to see you. So we've been talking about this all morning long. Some would argue the market is much calmer today than it was a couple weeks ago. What do you think the market might be trying to sniff out later this year? A better economic backdrop, corporations still doing well? How do you see it?
Absolutely. Thanks for having me back. The U.S. markets had a tough start to 2022, absolutely. And then as of yesterday, basically recovered everything that was lost from the beginning of the Russia-Ukraine war, which started February 24th. So moving forward, we still think the market can inch higher through year end. It won't be a straight line, but a couple of things that the market's looking for, as you mentioned, the Russia-Ukraine war, hopefully negotiations continue. If there's any semblance of ceasefire, I think that's great for markets. Secondly, we do think that investors are pricing in the Fed being able to do a soft land in terms of rate hikes. And then also thirdly, if you think about stocks have become a little cheaper. So we've seen retail investors come back, but also institutional investors come back in terms of short covering. So those are three reasons why the market has bounced back quite a bit over the course of the last few days.
Candice, I want to pick up on the soft landing idea. It's Julie here. They've been pricing in a soft landing. Do you guys think that soft landing is actually going to happen? There are definitely some market participants who are not so sanguine on the Fed's ability to land the plane without some turbulence.
Absolutely. I think the risks continue to increase because it's not solely just the Fed's responsibility to solve all of the economy's problems. Now you have the Fed dealing with high inflation, levels of unemployment that are still sticky because of the Great Resignation. On top of that, you have a Russia-Ukraine war that nobody could have predicted. So all of those things allow for the Fed to have a tougher job. But we do think that the Fed is moving towards 7 hikes this year. They already started with a 25 basis point hike earlier this month. We do think it's followed by a 50 basis point hike on May and also June. And then for the rest of the 4 hikes following should be 25 basis points. So 7 hikes in total for this year, a potential for 3 hikes in the following year. So hopefully the Fed will continue to be highly communicative, which they have been, as we've seen Chairman Powell come out many times over the course of the last few weeks to speak about what the Fed plans to do. So hopefully that's a good indication for the markets to price in exactly what the Fed is looking to do in their next meeting.
7 rate hikes, Candice, that's a lot. What sectors do you think will outperform in that type of backdrop?
Absolutely. I think if we had to focus on a number of sectors, technology is still going to do well. Healthcare is still going to do well. But in addition to that, with the commodity prices increasing and the demand supply shortage, I do think energy is another sector that should continue to do well also.
We've been talking sort of very high level here about these macro events. Sozzi and I have been looking at some of the most recent earnings reports to try to find if there are any signs of trouble at all for the corporate profit outlook. And I'm wondering what you're seeing on that front.
Absolutely. We still think that EPS growth is still strong this year, although nothing like what we saw last year, 40+% EPS growth due to the recovery. We do think we can achieve anywhere maybe 5% or north of 5% this year, still leading us to historically high EPS growth. So from that perspective, we do think that corporations are still strong. For the markets to move higher, I do think it will be relying on EPS growth, not so much multiple movement. So we do think that corporations are still strong. One area of struggle could potentially be margins, where wage growth and continued wage growth may take a toll on companies that are unable to pass prices over to the consumer.
Candice, I want to switch gears, if you'll allow me, because you guys just put out a white paper looking at diversity in asset management, specifically female to male diversity in asset management. And well, I mean, these reports are always so depressing. I mean, I guess there's some improvement that we've seen here, but men still dwarf women in terms of the number of men in the profession versus women. What are some of your takeaways here?
Absolutely. So we published a paper on International Women's Day, which was a couple weeks ago, and it was titled The March of the Women, Increasing Diversity in Asset Management. And what we wanted to do was take a look into our specific industry, because as we all know, being in this industry for so long, diversity is a key concept when it comes to investing. We all want to reduce the amount of volatility in a portfolio. We want to increase the risk and return within your investments. So the same should be held in terms of who you hire within your firm and within your business. And we do do think that by diversifying the type of people that join your team, whether it's diversity of thought, all of those things could potentially lead to better alpha and also less volatility as well. So what we found was we took a look at two things. We took a look at women representation within portfolio management, so investors, and then we also realized that women don't all want to be portfolio managers, nor should they be. They want to be. So we also look at asset allocators. So from the investment side, we took a look at portfolio managers within equities and fixed income in the public space. And we saw that 11% of the entire universe is female portfolio managed, which is still very small. It hasn't gone up in many, many years, and it's pretty much stayed stable. And then in terms of alternatives, we've seen a better trajectory where you start off with more female analysts joining firms within the alternative space. But as you move up the ranks, you see levels of seniority dwindle. So the key there is it's not about attrition. The attrition between women and men within the alternative space is very similar, but it's the promotion rate that is different. And then within the asset allocator side, we took a look at institutions. So public plans, who are the largest, I would argue, across the US and have the biggest ability to make a difference. But you also have consultants who they work with, and you have endowments and foundations, and then, of course, the financial advisory services business. So what we've seen to date is that public plans are focused on diversity, because they have public constituents who have voted public figures into office, and they are very focused on that. But regulations really hinder their ability to increase diversity, because oftentimes with fiduciary rules, they'd actually have to carve out and set aside different programs like emerging market programs to be able to bring in diverse managers. And of course, when things hit like pandemics or other things that may come up, those are the first programs to get cut. So from our perspective, we do think that there should be more women in this wonderful industry, but there are a number of things that we can all do within asset management to push that forward. We can't do it alone here at Goldman Sachs. You can't do it alone there at Yahoo Finance as well. We all need to work together and continue this conversation.
Well, that's one of the reasons that we like to have you on, Candice, and that we try to make a conscious effort to have women in finance on. So we appreciate your voice on this issue and on the markets more broadly, too. Candice is Managing Director and Global Head of Strategic Advisory Solutions at Goldman Sachs Asset Management. Thank you so much, Candice. Appreciate it.